On January 31st, 2026, President Donald Trump announces his pick for the next Federal Reserve Chair, Kevin Warsh. Within minutes, the dollar index surges 0.53%. Gold crashes 5.35%, falling $284.80. Silver gets annihilated, plunging 13.16%, down over $15 per ounce. But the shockwaves don't stop there. The yen falls 1.01%. The euro drops 0.64%. Treasury yields spike. Precious metals ETFs that hit 3.5-year highs just days earlier start hemorrhaging value. One name, one announcement. $9 trillion in market value swinging across currencies, commodities, and assets worldwide. This isn't just another Fed chair appointment. This is a regime change, a signal that the era of easy money, weak dollar policies, and unlimited central bank support might be ending. Today we're dissecting the Warsh effect, how one nomination restructured global markets in hours, exposing why Trump's choice matters more than any policy speech, revealing what hawkish on inflation actually means for your portfolio, and explaining why this could be the moment historians point to as the day the 2020s monetary regime died. Who is Kevin Warsh and why markets panicked? Let's start with the man himself, because understanding Warsh explains everything that happened Friday. Kevin Warsh served as a Federal Reserve governor from 2006 to 2011. That time frame is crucial. It spans the entire financial crisis and its aftermath. During his tenure, Warsh became known for several positions that now have markets terrified, hawkish on inflation. Unlike many Fed officials who prioritized employment or growth, Warsh consistently emphasized inflation risks. He warned that aggressive monetary easing would create long-term inflation problems. He was right. The money printing that started in 2008-2009 eventually contributed to the inflation we saw in 2021-2023. Warsh saw it coming 15 years ago. Skeptical of rate cuts, the market data describes Warsh as less supportive of deep interest rate cuts. This matters enormously right now because markets have been pricing in 2 rate cuts in 2026, about 50 basis points total. If Warsh becomes chair and resists those cuts, keeping rates higher for longer, that completely changes the financial landscape. Focus on financial stability. Warsh isn't just about fighting inflation. He's concerned about asset bubbles, excessive risk-taking, and financial system stability. Right now, with stocks at elevated valuations, real estate prices high, and commodity markets in parabolic moves, Warsh might see exactly the kind of excess he warned about in 2006-2007. The market reaction Friday was instantaneous because traders understood immediately. Warsh as Fed chair means higher rates, tighter policy, stronger dollar, and lower asset prices across the board. The dollar's revenge, up 0.53% and climbing. The dollar index jumped 0.53% to 96.48 on Friday. That might not sound dramatic, but context is everything. Just days earlier, President Trump had said he was comfortable with the recent weakness in the dollar. The dollar had sunk to a nearly 4-year low on Tuesday. The market interpreted Trump's comments as green-lighting dollar weakness. Capital fled. The dollar debasement trade accelerated. Gold and silver surged. Then Friday's Warsh announcement reversed everything. Why did the dollar rally? Hawkish Fed expectations. If Warsh maintains higher rates while other central banks cut or hold steady, the dollar becomes more attractive. Higher U.S. rates mean better returns on dollar-denominated assets. Inflation-fighting credibility. Markets believe Warsh will prioritize fighting inflation even at the cost of economic growth. This gives the dollar credibility as a stable store of value. Policy shift signal. The nomination signals that despite Trump's comfortable with weakness comment, actual policy will support the dollar through hawkish Fed leadership. But here's the crucial detail that accelerated the dollar rally. The economic data released Friday. U.S. December PPI, Producer Price Index, rose 0.5% month-over-month and 3.0% year-over-year. Expectations were 0.2% and 2.8%. That's significantly hotter than expected. Wholesale inflation is running well above forecasts. PPI ex food and energy, even worse, rose 0.7% monthly and 3.3% yearly versus expectations of 0.2% and 2.9%. Chicago PMI surged to 54.0, up 11.3 points from December. Expectations were 43.7. This is the strongest expansion in over 2 years. What does this data tell us? The economy is running hot. Inflation pressures are building. Business activity is accelerating. This is precisely the environment where a hawkish Fed chair like Warsh would keep rates high or even consider raising them. The combination of Warsh's nomination plus inflation data running hot created the perfect storm for dollar strength. And when the dollar rallies, commodities priced in dollars, especially precious metals, get crushed. Gold's 284 collapse. The debasement trade unwinds February. COMEX gold fell 284.80, down 5.35%, settling around $5,000 per ounce. Just Thursday, gold had hit an all-time high of $5,586.20. In less than 24 hours, it gave back 586 of gains. Why such violence? The entire gold rally was built on the dollar debasement trade. Here's how that worked. The setup. Dollar weakness driven by Trump comfortable with weak dollar, massive U.S. deficits, 36+ trillion debt, foreign investors pulling capital from U.S. assets. Political polarization and fiscal uncertainty. FOMC expected to cut rates by 50 basis points in 2026. The trade. Buy gold as insurance against dollar losing value. If the Fed keeps cutting rates and the dollar keeps falling, gold becomes the ultimate store of value. The crowding. Everyone piled in. Long holdings in gold ETFs climbed to 3.5-year highs. Wednesday, just 2 days before the crash. The unwind. Warsh nomination signals the opposite of everything supporting the trade. Hawkish Fed, potential for higher rates, stronger dollar. Suddenly, the entire premise collapses. If the dollar isn't being debased, why own gold? The article notes that gold is supported by safe haven demand amid uncertainty over U.S. tariffs and geopolitical risks in Iran, Ukraine, the Middle East, and Venezuela. All true. But Friday proved that monetary policy expectations trump geopolitical concerns. Iran tensions persist. Ukraine situation unchanged. Venezuela crisis ongoing. Yet gold crashed 5.35% because the Fed chair pick shifted rate expectations. This reveals something uncomfortable. The gold rally wasn't primarily about geopolitics. It was about monetary policy and dollar weakness. When that narrative flipped, geopolitics didn't matter. Silver's $15 plunge when safe havens aren't safe. If gold's move was violent, silver's was catastrophic. March COMEX silver plunged $15.054, down 13.16%. Thursday, silver had touched an all-time high of $120.07. Friday, it crashed below $105. That's a 15 plazas decline in hours. Silver's crash was worse than gold's for several reasons. Smaller, more volatile market. Silver's total market value is a fraction of gold's. The same dollar amount of selling creates much larger percentage moves. Industrial demand concerns. About half of silver consumption is industrial: solar, EVs, electronics. If Warsh's hawkish policy slows economic growth or triggers recession, industrial demand collapses. Leverage amplification. Silver attracts more speculative, leveraged trading. When margin calls hit, the liquidation cascade is more violent. Momentum breakdown. Silver was in a parabolic rally. It had surged 56% in January alone. When parabolic moves break, they reverse with equal violence. The article notes that long holdings in silver ETFs rose to a 3.5-year high on December 23rd. That's extreme crowding in the trade. Everyone who was going to buy had already bought. There were no new buyers to support prices. When selling pressure hit, there was nobody on the other side. Silver's 13.16% crash is the market equivalent of a stampede for the exits with one door. The government shutdown deal, reducing safe haven demand. Here's a detail that compounded the precious metals crash. Trump announced late Thursday that he reached a tentative deal with Senate Democrats to avert a government shutdown. Why does this matter? Government shutdowns create uncertainty. Uncertainty drives safe haven demand for gold and silver. People buy insurance when they're worried. The deal funds Homeland Security for 2 weeks and provides full-year funding for several agencies. It removes immediate political crisis risk. This reduced safe haven demand at exactly the wrong moment for precious metals bulls. They were already facing Warsh nomination, hawkish Fed, stronger dollar. Hot inflation data, PPI above expectations. Strong economic data, Chicago PMI strongest in 2+ years. Now add, reduced political uncertainty from shutdown averted. It's a perfect storm of bearish factors hitting simultaneously. Precious metals need fear and uncertainty to thrive. Friday delivered the opposite: policy clarity, Warsh nomination, economic strength, PMI data, and political stability, shutdown avoided. Central bank buying, the support that wasn't enough. The article points to a seemingly bullish factor for gold: strong central bank demand. China's PBOC increased gold reserves by 30,000 ounces in December, the 14th consecutive month of increases. Total PBOC holdings reached 74.15 million troy ounces. The World Gold Council reported global central banks purchased 220 metric tons in Q3, up 28% from Q2. This is real, documented buying from some of the world's largest and most sophisticated holders. So why didn't it support prices Friday? Central bank buying is slow and steady. They accumulate over time, absorbing supply gradually. They're not reactive traders responding to daily headlines. Speculative selling overwhelms central bank buying. When leveraged traders and ETF holders panic and dump positions, the volume swamps central bank accumulation. Different time horizons. Central banks buy for strategic reasons over decades. Speculators trade on daily news. Friday was dominated by speculative selling, not strategic buying. Central bank demand provides a long-term floor under gold prices. It doesn't prevent violent short-term corrections. Friday proved this distinction brutally. All the central bank buying in the world couldn't stop gold from falling 284 when sentiment shifted on the Warsh nomination. The FOMC liquidity injection, when more money doesn't help. Another bullish factor mentioned, the FOMC's December 10th announcement of a $40 billion per month liquidity injection into the financial system. More liquidity should support precious metals prices, right? More money chasing the same amount of gold should drive prices higher. But Friday, it didn't matter. Why? Liquidity is already in the system. The $40 billion monthly injection is ongoing. It's not new news Friday. Markets had already priced it in during the January rally. Hawkish Fed chair changes the calculus. If Warsh becomes chair and signals tighter policy ahead, the existing liquidity injection might be reduced or eliminated. Liquidity helps during rallies, not crashes. When markets are rising, liquidity finds its way into assets. When markets are crashing, liquidity sits in cash. Nobody buys falling knives just because there's cash available. The liquidity injection supported the January rally. But it couldn't prevent Friday's crash because sentiment had shifted from risk on to risk off. The currency cascade, euro, yen, and global impacts. The Warsh effect didn't stop at precious metals. It cascaded through global currencies. USD down 0.64%. The euro fell as the stronger dollar weighed on the currency pair. Ironically, Eurozone economic data Friday was actually positive. Unemployment fell to a record low of 6.2%, expected 6.3%. Q4 GDP rose 0.3%, expected 0.2%. German CPI came in at 2.1%, expected 2.0%. Strong European data should support the euro, but it didn't matter. The Warsh-driven dollar strength overwhelmed everything. USD JPY up 1.01%. The yen fell sharply. A 1.01% move in a single day is massive for major currency pairs. The yen's weakness was compounded by several Japan-specific factors. Retail sales fell 2.0%, the largest decline in 5.5 years, expected 0.5%. Tokyo CPI rose just 1.5%, the smallest increase in 3.75 years, expected 1.7%. Polls show PM Takaichi's party may win majority. Raising fiscal concerns, Japan's economic weakness plus US dollar strength created a double whammy for the yen. But here's the fascinating geopolitical subplot. U.S. Treasury Secretary Bessent said Wednesday that the U.S. is absolutely not intervening in forex markets to support the yen. Earlier in the week, there had been speculation about potential U.S.-Japan joint forex intervention. That speculation briefly supported the yen. Bessent's denial killed that hope. Japanese authorities had called major banks Friday requesting dollar-yen quotes, a possible precursor to intervention. But U.S. refusal to participate left Japan acting alone, if at all. The yen crashed because the market realized Japan won't get U.S. help stabilizing the currency. The rate cut probability collapse. Here's a critical data point buried in the article. Markets are now pricing in just 16% odds of a 25 basis point rate cut at the March 17 to 18 FOMC meeting. Just days earlier, rate cuts in early 2026 seemed almost certain. Markets were pricing in 50 basis points of cuts total for the year. Friday's Warsh nomination changed everything. If Warsh becomes chair in May, he'll need Senate confirmation first. But markets are already pricing in his hawkish influence, assuming he'll resist the rate cuts currently expected. This probability collapse from high likelihood to just 16% is a massive repricing, and it explains the violence across asset markets. When rate cut expectations evaporate, dollar strengthens, higher rates attract capital, stocks fall, higher rates reduce valuations, bonds fall, yields rise as rate cut hopes fade, commodities fall, stronger dollar, higher opportunity cost, real estate faces pressure, higher mortgage costs. Everything moves simultaneously. This is the Warsh effect in action. Fed Governor Waller. The dovish voice ignored. Amid Friday's carnage, there was one dovish voice trying to push back. Fed Governor Christopher Waller. Waller said, Friday, monetary policy is still restricting economic activity, and economic data make it clear to me further easing is needed. This is a clear call for rate cuts. Waller is saying policy is too tight and needs to be loosened. The article notes this was bearish for the dollar when Waller made the comment. But here's the crucial observation. Waller's dovish comments didn't stop the dollar rally or prevent the precious metals crash. Why? Because Waller won't be Fed chair. Warsh will, pending confirmation. Markets trade on who has power, not who has opinions. Waller can call for easing all he wants. If Warsh as chair resists easing, Waller's voice doesn't matter. This is a brutal reminder. In central banking, the chair's view dominates. Dissenting governors can speak, but the chair sets the agenda. Friday's market action completely ignored Waller's dovish stance, pricing in Warsh's hawkish approach instead. The underlying dollar weakness versus Warsh strength. The article presents a fascinating tension. The dollar faces underlying weakness from structural factors, yet rallied Friday on Warsh news. The structural weaknesses remain. FOMC expected to cut rates by 50 BP in 2026. BOJ expected to raise rates by 25 BP. ECB expected to leave rates unchanged. Growing U.S. budget deficit, fiscal profligacy, political polarization, foreign investors pulling capital from U.S. All of these factors are real and ongoing. They didn't disappear Friday. But Warsh's nomination introduces a counterforce, a Fed chair committed to fighting inflation and maintaining policy credibility even at the cost of economic pain. This creates a battle, structural dollar weakness versus hawkish Fed policy support. Which wins? Friday, hawkish policy support won decisively. The dollar rallied despite all the structural headwinds. But those headwinds haven't gone away. They're still there, waiting. This sets up a potential scenario where the dollar rally on Warsh news is temporary. Once reality sets in, that the deficit isn't shrinking, political polarization isn't easing, foreign capital isn't returning, the structural weakness could reassert itself. Or Warsh's credibility could be so strong that it overcomes the structural issues, at least temporarily. This is the key question for 2026. Structural dollar weakness or hawkish Fed support? Which force dominates? What happens next? The confirmation battle. Here's what most coverage is missing. Warsh isn't Fed chair yet. He's been nominated. He needs Senate confirmation. The confirmation process could be quick and smooth. If Senate Republicans and moderate Democrats support him, Warsh could be confirmed within weeks and take office when Powell's term ends in May. Contentious and delayed. If progressive Democrats oppose him as too hawkish, the confirmation could be delayed or even derailed. This would create uncertainty and potentially reverse Friday's market moves. Modified positioning. During confirmation hearings, Warsh might soften his hawkish rhetoric to win votes. If he signals more flexibility on rate cuts, markets could reverse the Friday sell-off. The next few weeks of confirmation hearings will be crucial. Every statement Warsh makes will be parsed for clues about his actual policy intentions. Markets hate uncertainty. The nomination created clarity Friday. Hawkish chair, Almar, stronger dollar, lower gold. But the confirmation process could reintroduce uncertainty. The technical damage. Let's talk about what Friday's moves mean technically for precious metals. Gold fell to around $5,000, breaking below the psychologically crucial $5,000 level intraday before recovering slightly. The key technical levels now. Resistance at $5,200, $5,300, Friday's early levels. Support at $4,150, $4,900, previous consolidation zone. If gold can't reclaim $5,200 quickly, it suggests the rally is over and deeper correction to $4,500, $4,800 is coming. Silver crashed below 105, breaking the psychologically important round number. Key levels: resistance at $110, $115 and support at $95, $100. Silver breaking below $100 would confirm the parabolic rally has ended and much deeper correction is underway. The technical damage is severe because both metals broke key support levels and did so on massive volume. This suggests genuine selling pressure, not just profit-taking. The broader market implications. The Warsh effect extends far beyond precious metals and currencies. Stocks. Higher for longer rates mean lower valuations for equities, especially growth stocks. Tech valuations get compressed when the risk-free rate, treasury yields, rises. Bonds. If Warsh keeps rates high, bond prices fall, yields rise. This pressures fixed income portfolios. Real estate. Higher rates mean higher mortgage costs, reducing housing affordability, and putting pressure on real estate prices. Emerging markets. A strong dollar makes dollar-denominated debt more expensive for emerging market borrowers to service. This creates credit stress. Commodities broadly, not just precious metals. A strong dollar pressures all dollar-denominated commodities: oil, copper, agricultural goods. The Warsh nomination is a regime change moment. It signals the end of the easy money era and the beginning of a period where inflation fighting takes precedence over growth support. This is 1980s Paul Volcker-style Fed policy making a comeback. Volcker broke inflation by hiking rates to 20%, triggering a recession but restoring price stability. Warsh won't go that far, but his nomination signals a willingness to prioritize inflation over growth, which is a fundamental shift from the 2020-2024 period. The bottom line: President Trump nominated Kevin Warsh as the next Fed chair on Friday. Markets responded with a $9 trillion earthquake across global assets. The dollar index surged 0.53%. Gold plunged 284.80, 5.35%. Silver crashed 15.054, 13.16%. The euro fell 0.64%. The yen dropped 1.01%. Warsh is known as hawkish on inflation, skeptical of rate cuts, and focused on financial stability. His nomination signals higher for longer rates, tighter policy, and a stronger dollar. The timing was brutal. Hot inflation data, PPI above expectations, strong economic data, Chicago PMI strongest in 2+ years, and reduced political uncertainty, shutdown deal, all hit the same day. The entire precious metals rally was built on dollar debasement fears. Warsh's nomination killed that narrative instantly. Gold ETF holdings at 3.5-year highs became massive overweight positions that had to be liquidated. Central bank buying, FOMC liquidity injections, geopolitical tensions, none of it mattered Friday. Monetary policy expectations trumped everything. The Warsh effect reveals that in modern markets, Fed chair selection matters more than wars, deficits, or geopolitics. Because the Fed chair controls the money supply, and the money supply controls asset prices. Whether Warsh's hawkish approach actually materializes depends on Senate confirmation and his actual policies once in office. But markets aren't waiting. They're repricing now for a world where inflation fighting takes precedence and easy money ends. The 2020s monetary regime, characterized by unlimited liquidity, dovish policy, and asset price support, might have died Friday. Welcome to the Warsh era. Buckle up. If this helped you understand the regime change, hit that like button and tell me, do you think Warsh will actually follow through with hawkish policy or moderate once confirmed? This has been your guide to the day monetary policy changed everything. Thanks for watching, and I'll see you in the next one.